Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. We talk about real estate every week on this program. Today, we're going to take a little different turn and talk about the paper side of real estate. That is note investing. Where is there opportunity and how can it fit into your portfolio? And we've got an awesome guest today on the Real Estate Guys radio program.
With everything going on in the world, don't let your lack of financial understanding derail your investments. Real estate investors need to see the bigger economic picture. The Federal Reserve, bonds and interest rates, precious metals, oil and gas, cryptocurrency, and the inner workings of monetary policy, just to start. If you're at all confused about how and why market metrics intersect and what it means to you as a real estate investor, take your understanding to a new level with the Future of Money and Wealth video collection. Discover the opportunity to hedge against inflation, deflation, and stagflation. Gain critical insights on real estate niches that perform well in challenging times, and learn specific strategies to fortify your balance sheet before it's too late. Simply send an email to future@realestateguysradio.com for all the details. The Future of Money and Wealth includes 20 videos of powerful presentations and panel discussions featuring Robert Kiyosaki, Peter Schiff, G. Edward Griffin, Dr. Doug Duncan, Simon Black, CPA Tom Wheelwright, Brian London, Dr. Chris Martinson, and many more. Email future@realestateguysradio.com today.
Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Joining me, as usual, it's our co-host and financial strategist, Russell Gray.
Hey, Robert.
You have been chomping at the bit for this show, I know, Russ, because today we're going to talk about the other side, the paper side of real estate investing. Lots of our listeners own houses and commercial centers and shopping centers and multifamily and resort property. And today we're going to talk about kind of the opposite side of the coin, which is investing in paper, the notes, the mortgages associated with real estate.
Yeah, it's really a very interesting part of the business, and a lot of real estate investors don't pay any attention to it. When they think of getting a mortgage or they think of mortgages, they think of being the borrower. They don't think of being the lender. And when you're investing for cash flow, you could make the argument that if you're purely a cash flow investor and you're not interested in developing equity, and you're certainly not interested in being a landlord, owning a note could be a good way to go. But it's bigger than that because you can actually create equity in notes. And a lot of people don't understand that. And I'm sure we'll get into that today.
Well, don't jump too far ahead. No investor left behind. When you borrow money to buy real estate, it creates this note. And our guest, who is well versed on this subject, is going to run us through exactly how that works. But it's a promise to pay, and you're making that payment. And where many people first understand private notes is when they think about selling a property. And because of the market or their situation, maybe their agent says, what are you going to do with all this money? Have you considered maybe carrying back paper? And they go, well, what is carrying back and what is paper? And that just means that you become the bank. You would lend the money. You sell the house, but now you take a predictable stream of income. And so that's how most people, I think, approach it, is they're going to finance it themselves. But the whole world of notes, as you're talking about, Russ, is much bigger than that.
Yeah, well, obviously Wall Street likes it. If you think about it, just look at the concept of financial planning from a Wall Street perspective. You have stocks, which are equities, and bonds, which are debt. And you want to be on both sides in a balanced portfolio because you're hedged against inflation, you're hedged against deflation. One, you're investing for capital gain. The other, you're investing for current income, preservation of capital. I can make the argument all day long that owning a private mortgage is much better than owning a bond, not just for the yield's sake, but for all of the resolution options you have if something goes sideways. So I'm sure we'll get into that today. But the thing to understand is that as a real estate investor, we think about properties, we think very transactionally. When I first got into this business, having come out of the financial services side of things, I looked at real estate investing from a portfolio perspective. And if you listen to people as that thought process has developed in the marketplace over the last 20 years, you see people understanding that one of the most valuable assets you have is debt. In a marketplace where there's a lot of inflation going on, the argument is, hey, you want to be in as much debt as you can. And so you flip that over and go, well, then why would I want to buy notes? And the reason is because, to your point, Robert, when someone owns a note, it's illiquid. And when they want to liquidate it, they have to sell it typically at a discount. And so these notes, just like bonds, trade. And in those trades, there's a market made and there are opportunities. And because it's a highly inefficient market, which is the hallmark of real estate, which is why there's so much opportunity in real estate, that same inefficiency exists on the note side as well. So you can get deals. And when you get deals, you can get built-in equity and debt, just like you do in mortgages. So these are all somewhat sophisticated concepts. But again, that's why we have an expert guest who plays this game, and he's going to help us understand it all.
We're going to learn where the opportunity is for individuals to own notes, trading notes, how you create notes, and more. We come back, you'll meet Jim Griffin. He's with Glastonbury Thorn, and they're a firm that is providing concierge services for folks who are interested in the note business. He's got an amazing background in business and in real estate. You'll meet him next on the Real Estate Guys radio program.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
When it comes to successful rental property investing, it pays to be picky. Pick the right markets, pick profitable properties, and pick great property management. That's easier said than done, but we've got great news. Terry Kerr and his rockstar team at Mid-South Homebuyers are going strong in Memphis, Tennessee, and Little Rock, Arkansas, too. So for a top-notch turnkey single-family home rental property, whether you're a new investor or have a large portfolio already, pick Terry Kerr and Mid-South for a truly A-plus investing experience. To learn more, send an email to midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com.
Hey, it's Gene from the Residential Assisted Living Academy. The silver tsunami of seniors is coming. You've been hearing me tell you about that for years now on the Real Estate Guys, and it's true. You know, with everything that's going on in our world today, the safest place for a senior to be is a residential assisted living facility. The best place to be for cash flowing real estate in the current economy is residential assisted living. You know, I've been telling you about it. The silver tsunami is here. But if you'd like to learn more, be educated, and get the information that can really propel you into the future, I'd love to share that with you.
To gain access to an informational webinar presented by certified financial planner and real estate entrepreneur Gene Garino, and discover how you can turn a nice home in a nice neighborhood into a cash flow machine, send an email to ALF, A-L-F, at realestateguysradio.com. That's ALF at realestateguysradio.com.
Hi, this is Mark Skousen, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio show, heard every weekend on this great radio station all the time at realestateguysradio.com. We talk real estate a lot. This week we're talking about a very interrelated topic, which is the paper side of real estate. You don't actually have to own the house. You can own the deed or the mortgage or the note associated with the house. Let's talk about that from Glastonbury Thorn. Please welcome Mr. Jim Griffin. Hey, Jim.
Hello, Robert. How are you today?
I'm great. It's great to have you on the program, not just because you're an expert at what we're going to talk about, because you have an amazing voice, my friend.
Okay, well, that's a good start then.
So, hey, before we get into the specifics of notes, which you spend most of your time talking about these days, give us a little insight into your background, not only in business, but also as a real estate investor.
Yeah, well, it's interesting because in the prelim, you were talking about all the different ways of real estate investing, and I have done and do all of those. So I have rental properties, I have rehabs, I've got infill projects, I'm subdividing land, I buy land, everything. I know it all, I love it all, but I have to confess I have a special place in my heart for notes. And of course, that's the area that we're talking about today. And I'll be very happy to share with you some of the things that I enjoy in particular about notes.
Well, the reason I wanted to have that perspective is people often talk about the private mortgage business who don't really understand the real estate side. I mean, you flipped houses and held for the production of income and all those different things. And so having that context and that perspective is important, because I think for a lot of our listeners, this is kind of new territory. I mean, they understand mortgages and so forth, but to be on the opposite side, to be the bank, if you will, is something they maybe haven't thought of. And there's some real reasons why that could make sense as they're building a portfolio. Talk about some of the reasons as an investor that you like holding and investing in notes.
Well, there's so many different reasons, but one of the things that's nice about notes is how simple it is. I mean, just imagine, now you get to sit in the leather armchair. You're just checking to see. I mean, there's really nothing to do. You made your decision. The payments are being made. They arrive in the mailbox or they come ACH into your bank account. You can be anywhere in the world. That's a lot different, as I can definitely attest to some of the other types of investing I do in real estate.
Well, and that's one of the things that people don't think about. They invest in real estate because they want cash flow, for instance. That's not everybody's driver, but many people would like the idea of a tenant making the mortgage payment and the property taxes and the insurance and a little more that becomes cash flow every month. Well, a note does that, and a note does that brilliantly, because what a landlord has is the risk and also the upside of owning a property, meaning that if rents go up, they could make more money. If the value of the property goes up, there's some equity and appreciation there. But the bank, think about what the bank does. They loan money for a predictable stream of income. And for many of us, the idea of having rentals where we're betting on the come a little bit, but having just a part of our portfolio that's a predictable, recurring, boring stream of income sounds pretty good.
Yeah. And the money that's coming in is pretty much all flowing to you. So, for example, in my rental portfolio, I'm obviously going to have to take, something out for maintenance. I don't know, maybe 10%. I'm going to have to take out something for management. Maybe that's another 10%. I'm going to have to take out something for taxes. Maybe that's another 10%. I'm going to have to take out something for vacancy. Maybe that's another 5%. I'm going to have to take out something for insurance. Maybe that's another 5%.
That's a lot of percent.
None of that gets taken out on my mortgages. It's about $35 for the third-party loan service provider, and the rest goes to me.
Well, let's talk about the mechanics of this, because there's a variety of ways that notes are created. If I'm a bank, I'm going to fund a real estate transaction. I have collateral, meaning that if for some reason the borrower doesn't pay me back, I can get to the property, and I'm going to do that at a reasonable loan to value that makes sense for me as the lender, but also makes the numbers work for the investor. So I can originate a mortgage, and that's a common way that mortgages are created, certainly through banks and local banks, big banks, federally chartered banks, but also through mom and pops. We've talked on this show about hard money lending and bridge loans and the kind of loans that are made in kind of a different manner. And I think the part that is interesting in what you do is that you mostly find these notes that have already been originated. Can you speak to that?
Yeah. One of the questions that people pretty quickly get to me is, why then is somebody selling this note? If they created this great note, why don't they keep it? The typical scenario is that somebody has got a business, a core business. Let's say, for example, they're in the business of subdividing land and building properties, and they're going to put owner financing on it. But now they need to go build the next subdivision. This is a typical scenario. It's not the only one, definitely, but where people are doing a certain kind of a cadence. They're putting owner financing in order to put these properties that they've developed onto the market, and then they need to recapitalize their business. So these portfolios of notes come into the marketplace, and then there's an opportunity to go look at them and pick and choose which one, might be the best. And those portfolios, of course, are going to be sold at a discount, as you just mentioned. So let's say that there's a note that was to the borrower was 10%. You have to pay a 10% interest rate, right? So typical scenario is I might buy that note at a 15% discount to the current value of the note. So that might leverage my return up to something like a 12.4%, simply because I paid less for that note than its face value. So that's how it works.
It's really just like cap rates in real estate. The more money that chases a particular property drives up the price. But if the income stays constant, then the capitalization rate or the cap rate is decreased. In this case, the note rate is set. It was set when the note was created. It's 10%. The borrower's paying 10%. Maybe it's a $100,000 note. But because of the way that notes trade, when somebody wants to take a note, that promise to pay, receiving that 10% payment every month, and convert that back to a pile of cash, they're going to discount it. And there's reasons why that works for them. Like you mentioned, a situation where they have another business need for the capital. they've been fine accepting that 10% payment every month. And all of a sudden it's like, wow, we could do something else if we had the capital. And it might make perfect sense for them to offer that as a discount. So to the purchaser of that note, there's a couple of interesting things about it. If I originate a note, I'm taking a guess about the borrower's ability to pay. That's why we have underwriting and we check credit scores and we get an appraisal on the property. I want to make sure that they're confident. But when you buy a note, it often has a history of being paid. Can you speak to that part of it?
Yeah, absolutely. And I love to see that history visually. I'll take that whole payment history, the date that it was due and the date that it was paid, and I'll calculate days and I'll put that on a graph and I'll see it on a timeline. And there's a number of things that I'll look at there. Of course, I want to see that the payments were being made on time. I also want to see what's the trend. Is it a neutral trend? Is it a negative trend? Is it a positive trend? I want to see was the most recent payment made? How many payments in all were made? There's a lot of things that I look at in that history, but you bet that is one of the key things I would look at when I'm evaluating a note.
And this is part of the risk assessment that you have when you're buying a note. So there's things like loan to value, and then there is the actual collateral. So when the bank originated the mortgage, or the private company did, and they checked out the collateral and they came up with some loan to value, say it was 75%. So they said, well, Mr. Johnson, you have a property that's worth $100,000. We'll loan you $75,000, 75%, which gives the bank or the lender some protective equity in case there are challenges. And it's at a 10% rate. Now, people might say, well, 75% and 10%, that sounds high. But these loans are often made in situations where traditional financing isn't available for whatever reason, the collateral, the borrower, the market, whatever that is, the size of the loan. And so now you've got this loan in place. But as time goes by, the loan may be amortized. Not all private notes are amortized. Sometimes they're interest only, but the loan may be amortized, meaning that that loan to value is getting smaller. At the same time, the property is increasing in value. So when you look at a note, that's got to be part of your risk assessment, is what is the collateral worth today?
Absolutely. In fact, there are two first letter TVs that are of interest. The first is the loan to value, and the second one is the investment to value. Actually, the investment to value is quite important to me. So I typically won't buy a note or propose a note to an investor where the investment to value exceeds 70% or maximum 75% of the total value of the property. So that gives me lots of buffer, lots of comfort if things go wrong. But the other one, which is the one you mentioned, is also of great interest to me, which is the loan to value, because the more that borrower put down up front to get that loan in place and to get that property that they want to live in, the more skin they have in the game. And I like that.
Yeah, the vested interest is really critical. And when you look at the programs that are available with less money down, that's usually as a way, an incentive to get new borrowers, first-time buyers, and those kinds of folks into properties. But that does come with the risk. Lenders are typically concerned with two things. How are you going to pay them back? They want to make sure that the borrower's qualified. And what happens if you don't, which comes back to the collateral and so forth. So, not to get too technical, but different states process loans in different ways. There's mortgage states, deed of trust states. Does that fall into your analysis? Are there particular areas where it's better to own paper than others?
So there's really two questions there. Does the mortgage versus, a deed of trust or land contract, and again, I know you don't want to get too far into the weeds about, the technical differences between a mortgage and a land contract. But the quick answer is yes, there are two different ways of doing it. Some states tend to do it more one way and other states tend to do it more the other way. Both are perfectly fine. I do have a slight bias towards mortgages for a variety of reasons that I could get into later, but it's okay. Land contract is also fine. The other question that you raised was, are some states better than others? So when I'm putting an evaluation together I have all of these criteria. In fact, I've created a document that lists quite a number of criteria for evaluating a note that I could share later if you wish. But you can imagine that there's no such thing as a perfect note, just as there's no such thing as a perfect boyfriend or a perfect girlfriend.
Right.
So what you're doing is you're just kind of thinking, okay, these are the strong points that I like a lot, and these are the areas that could be improved. And on balance, I think this is a great girlfriend or a great boyfriend. And it's the same thing with a note. And so when I take a look at factors, some are much more important factors than others, and some are less important factors. And one of those less important factors is the state. It's like I would buy a great note in any state. But there are some states where I have a little bit less fondness for a variety of reasons than others. Okay, granted.
Got it. Well, and let's talk about the other part of the note business, which of course is the interest rate and terms. When somebody originally borrowed this money, they might have paid some points or not, and that went to the originator. They have this interest rate that we've talked about, which is obviously one of the things you evaluate because it's going to vary. And I'm going to guess that it's not just the highest interest rate that you pick, it's the combination of factors, and especially as people are building a portfolio of notes. So talk about how you analyze what the return looks like and the rates compared to everything else.
Yeah, you can imagine that there's an underlying reason for everything, right? Well, I'm looking at cars that I want to buy, and this one seems amazingly cheap. Given the age and the model year. And the first thing that goes through my mind is, why is that one so cheap?
Yep.
Right? It's the same with notes. This one has an amazingly high interest rate, or interesting, actually what we refer to as yield, because to us, it's our yield.
Yep.
Has amazingly high yield. Why is that? When we see very high yields, my alarm goes off. Okay, what's wrong with this note? So generally, most of the good solid notes are going to deliver something in the 6, 8, 10%. Those are great notes, solid notes. They're right down the middle of the fairway. But let's take a step back. There are two broad classes of notes that we could be talking about. One is performing notes, and the other, of course, is non-performing notes. And my recommendation to an investor getting started in notes is to hit that ball right down the middle of the fairway for the first 2 or 3 or 4 notes and buy performing notes. That is the ones that people are making their payments and nothing is wrong. But granted, there is this whole other category investing, which is kind of like the equivalent or analogy would be a real estate investor that decides that they want to buy a rehab. Okay, I know I'm going to have to do some work on this thing, and I'm hoping to get a higher return in exchange for my active effort. Well, there's an equivalent to that in notes, which is buying a non-performing note and having to fix it and getting a higher return for that.
Well, I love that you brought that up, because when we think about notes, you think the first category, performing notes, you're buying that stream of income and you're wanting to rely on that. And that's part of the reason I would think folks that listen to our show who own property would consider putting a note in their portfolio, because it's just that repeatable, constant, same amount of money coming in every month, and it balances whatever other risk they might have in their portfolio. But non-performing notes can be pretty cool too, because there it's really about what the investment philosophy is of the person buying the note. If I'm just after cash flow, I want that performing, well-seasoned, good loan to value, solid note that I know the borrower will have no problem paying. It's not skyrocket interest rate. It's going to be easy. They're probably going to be in it forever or for a long time. But when you buy a non-performing note, there's always a story there, and the discount's going to be more. And sometimes people are after the property because there is collateral, but that's not always the case. Sometimes you do rehab the note. So talk to that part about it, because this is a fascinating area of private mortgages.
It sure is. There are actually several exit strategies. The first one is a loan modification, or in the lingo, a loan mod. So a loan modification is basically where sometimes the only thing that's wrong with a note is that it's something like a rolling 60 or a rolling 90. In other words, that borrower got behind at some point in time, and they're making their payments every month ever since. But it's always showing up. They're always getting the late penalty, and the loan is showing up as non-performing.
Yep.
So this is where you can be that kind person that says, you know what, I feel your pain. Let's do something to kind of help your credit score and make everything look better. Of course, you're also doing yourself a favor because you're transforming the note from non-performing to performing, right? So you say, let's just take these 2 months that you've been behind for the last 9 months and just stick them at the end of the note. By the way, imagine trying to say, let's take these 2 rental payments that you've missed and put them at the end of your rental tenancy.
Right.
So let's take these 2 monthly payments that you missed and stick them at the end of your note, and let's call you current. How does that sound? And maybe I'm going to give you some kind of an incentive if you continue to make your payments for the next 9 months, some good thing will happen. Okay, so that's a loan modification. Number 2 is where, let's say you've gone through that step, and the person says, you know what? I mean, I really appreciate it. I mean, you're the greatest, person, and I really appreciate all the effort, but you know what? It's really not going to work because of this, and this has happened, and Uncle Bill or Aunt Betty. So I have to just move on with my life. Okay, all right. Then what we have is something called deed in lieu, where basically somebody says, here, I'll give you the keys, I'll leave you the house in broom clean condition.
Yeah.
And in exchange, by the way, me as the investor, I'm going to give you some help to move on with your life, like maybe your first and last month's payment, or help with that moving van and something like that. And everybody feels very warm and happy in that story. And I have to do the third option, which is the foreclosure. Of course, foreclosure is the option everybody thinks of first. And yeah, that's going to cost about $3,000, maybe $2,500.
Yeah.
And there's a process for that too. And you know what? There's even a fourth option. And that option is just sell the note to someone like me at a discount.
Well, that's a great point, Jim. The interchangeability and the resale of notes is fascinating. We'll talk about that when we come back. Our guest is Jim Griffin. We're talking about the paper side of real estate. We'll be back, and we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Hey, ever wished you could go back in time and do some tax planning? Now you can, just like Marty McFly. Lucky for you, a brand new federal law just made this possible with an EQRP to get tax deductions and reduce your taxable income from last year, so you can use that tax savings to invest in real estate, Bitcoin, gold, even your own business. Whether you're a full-time investor, doctor, government employee, even if you have 5 or 50 employees, the EQRP works and is your secret weapon, and now it's retroactive. Hey, I'm Damian Lupo, and we have your solution. By the way, if you got bad advice and used an IRA for an apartment syndication, you are sitting on a U-bit time bomb. But don't worry, there's a solution, the EQRP. The EQRP company is ready to help you get control of your money, kill U-bit, and help you pay way less taxes. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report. Paying tax or letting Wall Street suck you dry is dumb. Your first step is freeing your retirement money by sending an email to eqrp@realestateguysradio.com today.
Hear ye, hear ye. Registration is now open for the Real Estate Guys 19th Annual Investor Summit. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning this year, our sales legend Tom Hopkins, the editor of the Gold newsletter Brian London, international real estate developer Beth Clifford, and Jim Rohn's 18-year business partner Kyle Wilson. And joining us live and in person for his 9th Investor Summit, Peter Schiff. Plus, returning for his 9th Investor Summit, best-selling author and the Rich Dad advisor for real estate, Ken McElroy. Plus, lots more to be announced. It all begins June 11th in beautiful Belize. Visit realestateguysradio.com and click the tab that says Summit to reserve your spot. This transformational week is like no conference you've ever attended. Go to realestateguysradio.com and click Summit and make plans to spend a week with the Real Estate Guys, Peter Schiff, Ken McElroy, and an all-star faculty on the 19th Annual Investor Summit.
Hey, it's Ken McElroy. I listen to the Real Estate Guys, and so should you.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Come and join us for the 19th Annual Investor Summit. It's gonna be amazing. It happens June 11th to the 19th. You can get all the details on the website at realestateguysradio.com under the tab that says Summit. We're talking about private notes, how you can invest in the paper side of the real estate business. And before we get back to our conversation with Jim Griffin, it's time to play Real Estate Trivia, your chance to win a prize by knowing today's Real Estate Trivia question. Just a minute, you'll hear the question. As soon as you think you know the answer, quickly send it to us at trivia@realestateguysradio.com. Trivia@realestateguysradio.com. You want to include your name, the answer to the question, and your physical mailing address, because if you're the first to get it right, you'll get an awesome compilation book called The One Thing That Changed Everything, inspiring stories from super cool people, put together by our good friend Kyle Wilson. That can be yours if you know today's real estate trivia question. Last week on the show, we were talking with attorney Mauricio Raoul, and we asked this: in which U.S. state is it a law that pickles must bounce? Well, as crazy as that sounds, it's true in the state of Connecticut. A pickle cannot be sold in Connecticut unless it bounces. According to a 1948 article, this law became a necessity after two scheming pickle packers tried to sell pickles unfit for human consumption on the sly. Connecticut's Food and Drug Commissioner at the time proclaimed that a real pickle should bounce when dropped from the height of 1 foot, leading to a new state regulation. Here's our real estate trivia question for this week. Where is the world's highest river? Yeah, of all the rivers in the world, which one is at the highest elevation? If you think you know, or you just want to guess, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Send us your name, the answer to the question, and your mailing address. The first person that gets it right gets this awesome book, The One Thing That Changed Everything. That's today's real estate trivia question. We're talking with Jim Griffin today about private notes, investing in the note side of real estate. There's a lot of paper underneath real estate investing. As real estate investors, we love leverage. We love the fact that we can put 20 or 25% down and the bank or someone else will loan us the money. But the opposite side of that is the stream of payments created when a note comes into being. And what Jim helps people do is acquire these notes, whether they're performing, non-performing, and etc. And I think, Jim, there's such a variety in the way people approach these things. But one of the underlying foundational parts of note investing we've kind of touched on, but it's the fact that once a note is in place, it actually remains negotiable. You can always go to a borrower. The borrower and the lender can sit at the table and restructure. Maybe they want to pay it off sooner, so you change amortization. Maybe they want a discount on the rate or the payment, and you do that in exchange for some other thing. So talk about the flexibility once a note exists.
Yeah, all of those things, those kinds of negotiations, which you just alluded to, can happen, especially if the borrower gets in trouble. But there's another kind of a negotiation that is also quite interesting. And I think you alluded to it at the beginning of the call, is when you or I, as the owner of that property, made a decision to sell that property on owner financing.
Yep.
So the way that I write that note, the way that I write that deal can have a big impact on the value of that note later on in the marketplace. And the value of that note to me. So I'll give you only one example out of many. It's very common that somewhere in year 5, 6, or 7, that borrower decide that they want to pay off the note.
Yep.
I don't want that borrower to go peddle that note to somebody else. I want first option to meet any offer that somebody else make. On my own note, there are other things as well. So this is a whole nother vista on notes. But if someone is an investor that's thinking about or has sold property on terms can be very wise to incorporate all best practices in the way that note is written.
Just like no two properties are the same, it's the same thing with notes and how they originated, how long they've been in, the amortization schedule. So it's a lot to get your mind around. But what I love about it is it's also pretty simple. You know when you have a note that's available, kind of what the deal is. So let's talk about that side of it. This has been very instructional for us to understand the reason why there's someone on the other side and all those things. But let's talk about specifically what you do, which is you match up available notes with investors that are going to be a good fit for the note. So how does that process work? I go, wow, this sounds pretty awesome. Jim, I'm interested. Now, how does the buffet of notes work?
So typically with the way that starts, I will probably spend time one-on-one with you, with that person, talking through what are all the criteria that might be important to you when making a decision about a note. And I'll show those one by one. And why? Why is this one useful? We'd already talked sort of randomly about some of them, like investment to value, and why is that, and what's the threshold that I set? And there's so many others. I'll give one more example out of many, is the PITI, the principal, interest, taxes, and insurance ratio to rental rate for that same property.
Okay.
Why would I care about the rental rate for that property? So the reason I find that interesting is because I want to know what kinds of options that borrower has if they were just to abandon that mortgage. And so if I see that the principal, interest, taxes, and insurance is substantially below or even equivalent to a rental rate for that same property, it's like, why would I, as the borrower, abandon this thing? I would have to pay more just to rent the same kind of a place.
Right.
So that's an example of a metric that I would look at. And so you can imagine the rich array of information can be laid out in a kind of a matrix. And I'm one of these kinds of people that likes to look at numbers and think about them and ponder them. And so that is that first conversation to say, look, here's all of the things that you can consider when handpicking a note that you would like to own. And then, of course, a dialogue is a two-way thing. So then you come back and say, yeah, well, here's what's important to me. Here's the kind of return that I need. Here's my time horizon, by the way. I don't really want to be in for more than X number of years because this other thing is going to be happening in my life or whatever. Okay, so that's you. That's about you. So then I go look for things that fit what you said you're interested in. Maybe there'd be 3 or 4 or 5 of them. And then you can look at them and say, oh, I like this one the best.
Well, I'm glad you brought up the timing because if you think about this, a real estate investor buys a property with some idea of a timeline. Maybe they figure, okay, I'm going to buy the property. We're going to do a little bit of work. We're going to get the rents up. I'm going to hold it for the production of income, and I'm going to sell in 5 years. Well, as the owner of the property, you completely decide when you want to sell. With a note, the borrower almost always has the option to pay it off whenever they want to. So you're not as in control. But at the same time, you, like an owner of a piece of property, also can choose to sell that note. Maybe you bought it and you got a discount and it's been performing a few years and you have a life change and you say, you know, I want to get out of this. So this is a ready market where people will buy and sell and exchange notes. And a lot of it has to do with, as you mentioned, their personal situation. But then how that actually happens and what the returns look like is also going to be a little dependent on the market. So one of the things you have to go in eyes open is that you might buy a note and be out of it in 9 months, even though you didn't expect to be, but the borrower paid it off. And then you just go back and get another one, I suppose.
Yeah, that's a nice event. So all of a sudden you got your payday. It's exactly what happens to the bank. So the bank suddenly gets an email or a letter saying we want the payoff amount. Well, obviously somebody's decided to sell their property and the title company needs to know what the payoff is. So you're going to get that big check in the mail, and then you're probably going to call me and say, okay, now I want to buy 2 notes. And so that's how it works. You start multiplying your portfolio in that way.
Absolutely. So as you're building your portfolio of all of your investments, and people today have different markets they like, different types of property they like. With the pandemic, there's been a change in demand in certain regional locations and certain types of property, other properties on sale. People have to figure that out. In the note business, you do want to look at the underlying property and understand, the financial metrics and so forth. Of the notes that you guys place, how many are owner-occupied properties where the borrower's living in it versus, say, an investor or retail or commercial or any of that? Do you ever deal in those kinds of notes?
That's a great question, and that's actually one of the criteria as well. So one of the criteria that I recommend for an investor buying their first 2 or 3 or 4 notes is that it be owner occupied. I give more value to a note that is owner occupied versus one that's being rented. Not that being rented isn't a terrible thing, but for obvious reasons, I give more value to that one.
Just like a lender does, right? Lenders give better rates and terms when you're owner occupied. If I have my 15th rental house and something happens as an investor, I'm more likely to let that thing go than if I'm living in the house. So that makes a lot of sense. But it also brings up this other part of it, which is, say it goes to the point where the holder of the note has to foreclose. And so my first question is, how often in your experience does that happen? And I'm sure it's just like real estate. If you bought it well, it has a better chance of performing. But how often is that a reality? And then what happens? The strategy there could be, well, now we will rent the house. We take the house back. We could just sell it, create another note, and now we have a note again, or we could keep it and hold it as a rental property, I suppose.
Yeah. So 2-part question. So it is more rare for parts of my portfolio to hit that because of the way I'm handpicking them. But people are getting behind in their payments. That's a national trend, and we know all the reasons why. So that's something that we're all looking at. But the exit, let's say we go to foreclosure. So there are a couple of exit strategies. One is, yes, to decide that you wanted to. Many of the listeners are active real estate investors, right? So some of those people would immediately think, well, just take this property. I know what to do about that. This is something that I do.
Yep.
So that's one opportunity. One is just to rent it as is. One is to sell it on owner financing, etc. So all of the same options that would be available to a bank are available to you because you're the bank.
So Jim's actually put together a really awesome report called How to Invest in Mortgages, Buying a Note from Soup to Nuts. We'll tell you how you can get a free copy of that before we're done. But I know there's a lot to explain here, Jim. So tell us about what's in this report and what you cover there that we don't really have time to cover here.
Well, we mentioned that there was this or that was a criteria. So probably the core of the report is a list of criteria that could be used to evaluate a note.
Awesome.
Boom, 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 boom. Here's the list. It's more than 20 criteria. And here's the thresholds that I would recommend to use for each of those criteria. So that's number one. In addition, it talks a little bit, it provides some information about some of the terms that you may not have heard, like what is an allonge and some of these kinds of things. So you can refer back to that and get that information. And then the last part of the report talks about the step by step. Okay, if you wanted to buy a note, here's step number 1, here's step number 2, the due diligence, here's the thing that you will expect to sign, boom, 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 boom. So it's all in one package.
Awesome. If you'd like a copy of that, all you have to do is send an email to privatenotes@realestateguysradio.com, privatenotes@realestateguysradio.com. You'll learn a ton, and we appreciate the fact that you educate folks about this because it's so integral to understanding an investment. But at the end of the day, I think your value add also is pretty awesome. Because you've been doing this and because you know what to look for and so forth, you're able to put things in front of folks that you've vetted, that you've gone through, that you've analyzed, and why it's possible to go out into the big bad world and create or find mortgages. You need somebody on your side that knows what to look for, knows where the bodies are buried, if you will. So talk about that part of it, how it is that you have got yourself in a position to have access to these notes, to know what to look for, and kind of what jazzes you about being in this business.
Yeah. So I consider myself to be a pretty smart guy. But I can tell you the first time you're buying a note, and no matter how many books you've read, your fingers hovering over the purchase button and you're like, have I missed something? So it's really nice to have somebody in your corner that you could just reflect off of and say, this is what I'm thinking. What do you think? Do you agree? I mean, that's priceless. And so that's why I've created this company, Glastonbury Thorn, that basically provides concierge services to well-informed investors who enjoy the process of hand-picking the notes. It's like, I want that one in my portfolio. That's fun. And so that's what we do.
Awesome. And just to be clear about it, Jim, you put an investor into a particular note. It's not a group of notes. It's not a fund. It's not a syndication. One investor, one note. That's how it works?
Yeah, that's my note. And so, yeah.
Great stuff. Well, this has been awesome. We don't often talk about the note side of real estate, but you're certainly a wealth of knowledge, and we appreciate that. If you're interested in getting Jim's report, it's called How to Invest in Mortgages, Buying a Note from Soup to Nuts. Just send an email to privatenotes@realestateguysradio.com, privatenotes@realestateguysradio.com. You get the report, plus you'll get Jim's contact information. So if this sounds interesting, you can reach out and talk to him more. Jim, great having you on the program. Thanks for being here today.
All right, thank you.
There's Jim Griffin. Are notes a way for you to add to your portfolio? Could be. We'll talk more about that from a strategy point of view next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Real Estate Guys listeners, are you tired of losing real estate deals due to financing issues? Have you had enough of waiting on banks, lenders, and investor groups to fund new projects? What if there were a way to eliminate all the hassle and invest in real estate on your own terms? I'm here to tell you there is. Patrick Donahoe here from Paradigm Life. I'm an Investopedia Top 100 Most Influential Financial Advisor, and I recently wrote a best-selling book about the financial strategy that changed my entire investment model, and the one that could change yours. To get a copy of my book for free and learn how you can maximize your real estate portfolio by acting as your own bank, send an email to mybank@realestateguysradio.com. Don't make another real estate deal without reading my book first. Email mybank@realestateguysradio.com now to get your copy for free.
Are you ready to profit in paradise? Hi, it's Robert Helms, and if you think real estate investing means tenants, toilets, and termites, think again. Located just a short plane ride from the U.S., a virtually untouched paradise awaits, the beautiful country of Belize. When you go to Belize with the Real Estate Guys, you'll spend 4 fabulous days discovering one of the most intriguing real estate markets I've ever seen. With its jungle rainforests, pristine beaches, and 81-degree turquoise water, Belize is one of the most beautiful places on earth. Plus, it's considered one of the top 7 tax havens in the world. Belize property is on the rise, and many experts think the best is yet to come. But don't just take my word for it. Come experience Belize firsthand at our upcoming investor field trip. When you join us, you'll discover the many reasons we love Belize, like tremendously undervalued beachfront land, super low taxes, ease of doing business, and so much more. Get the details at realestateguysradio.com. Just click on events. See paradise for yourself. Click events at realestateguysradio.com, and I'll see you in beautiful Belize.
Hi there, this is Danielle DiMartino Booth, author of Fed Up, an insider's take on why the Federal Reserve is bad for America, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, come hang out with the Real Estate Guys and an all-star faculty at our 19th Annual Investor Summit. It takes place June 11th to the 19th. It is filling up fast, but we'll make room for you if you're quick. Get to the website at realestateguysradio.com and click the button that says Summit. We're talking today about the paper side of investing in real estate. Instead of buying a house, you buy the note, and it's not an either or. This is a way to change your portfolio and diversify risk. Pretty awesome to get around Jim Griffin.
Yes, absolutely. And you can just tell by his demeanor that he's got the right kind of mentality to be on the paper side of the business. You know, I have that background in the mortgage business. I like the numbers more than the real estate itself, and I like managing the portfolio. And when I look at notes and the strategic purpose that they serve in a portfolio, you can think about the stresses on cash flow in an environment we have right now, right? People are struggling. And the challenge is that you're not seeing note moratoriums as much as you're seeing eviction moratoriums.
Right.
And so I'm not saying that there's not pressure to prevent foreclosure, but a lot of that pressure is on government financing. It's not on private notes. So, but the point is that, your net cash flows, he talked about the low expenses. And basically, you're getting paid with very little expenses, very little set-asides. Then if you don't get paid, it's no different than if somebody stops paying rent, except that the likelihood that an owner with skin in the game and with jeopardizing the roof over their head is probably going to be more likely to make the payment than a tenant. So in terms of the safety of the cash flow, I'd make the argument that the note is probably a much safer place to be. When you look at the bottom line yield in today's compressed cap rate environment, the yield is actually better. So if you're looking at your portfolio going, what can I put in my portfolio to stabilize cash flow, to reinforce cash flow, but without commensurate risk that I get when I'm on the equity side of things? Notes is the obvious answer. And of course, all of the remedies you have on the back end are better in a lot of ways than any other form of debt you could buy, and to a large degree, maybe even comparable. They're certainly comparable with what you have if you're a landlord.
I think there's a couple of ways to think about notes in your portfolio. One is diversity, for sure. But in our book, Equity Happens, we talk about this idea of critical mass. And that is, there's two phases to your career as an investor. There's your accumulation phase, and you're building up properties and equity and cash flow. And then you get to a point in your life where you're like, okay, I want to just turn that into a stream of income. One of the best ways to do that is to convert properties into notes. You don't have the headaches of tenants, toilets, and termites. Not that we all don't deal with that. We do, and we have property managers to do it. But it just, at some point in your career, maybe you've reached the point where you're like, just having that predictable stream of income sounds pretty good compared to the roller coaster of real estate.
Yeah, and I also think that for some people who have a hard time, if you really think strategically, and we're saying all the time, short the dollar, short the dollar, short the dollar, and you use debt as a borrower to short the dollar, well, then the opposite would be true. Why in the world would you want to be long the dollar as a lender? Well, the reason you'd want to do that is, first of all, for the reasons we've already mentioned, the stabilization of the cash flow, the simplicity of the ownership, but you really are first in line in a distressed market, right? If you're looking forward in some degree to distress in the market because you can go bargain shopping, the idea of standing on the courthouse steps and bidding with a bunch of other bidders who are all waiting to do the same thing, often bidding the thing up to where it doesn't make sense.
And who may be much better and seasoned at it than you are.
Yeah, that is a very different experience than the simplicity of being the only bidder and knowing exactly what the price is. When you go to foreclose on a property, you know exactly what the price is, because the price is the value of your note. And you're the only person in line, and nobody can push you out of line. You're it. So if you're thinking distress is coming and you want to accumulate property through distress, picking up notes in the face of that is not a bad way to go. Now, the other thing is in terms of, you may lose a little bit to inflation because you're long the dollar, but you gain that back in a distressed market as people are scrambling for liquidity. Because when people begin to sell assets because prices are going up and they need to generate dollars for whatever reason, then they're going to sell the things they have on their balance sheet, including the notes that they own, at substantial discounts. And so what you give up to inflation, you make on the buy with the discount. So again, I don't want to get too deep in the weeds strategically, but I just think that for people who have only given cursory thought to putting private notes in their portfolio, especially if you're non-accredited, right? If you're accredited, you have a lot of options, but if you're not accredited, you don't have as many options. And this is a really powerful option. I just think a lot of people don't really understand. So it's great to have a guy like Jim who put together a 30-page report because he's Mr. Thorough.
Of course he did.
Yeah. I mean, so it's something that I think people should take a serious look at.
We've known Jim's family a long time. He's a stand-up guy. He's written this amazing report. All you have to do to get a copy is send an email to privatenotes@realestateguysradio.com. There's another really cool strategy that we have zero time to talk about, but at our events we often talk about this, and that's arbitraging between properties and returns and notes. There's a big topic there. It actually plays into precious metals. And we've got a YouTube series called Precious Equity. Jim, in fact, is one of the guests that Russ has on that series. If you're interested in learning how to make money on the spread, the arbitrage, you're going to want to check out the series on our YouTube channel. Just send an email to preciousequity at realestateguysradio.com. Precious Equity at realestateguysradio.com. Big thanks to Jim Griffin for sharing his knowledge with us today. And until next week, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and Rich Dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.